Now, earlier this hour, Disney reported a 1.2% drop in second quarter profits. They missed analyst estimates and moved Disney shares lower, of course, in the after-hours trading, or as you may expect. Joining us now on the phone with his take on Disney's numbers, Barton Crockett, analyst at Lazard Capital Markets. Barton, thanks for joining us. Let me ask, first of all, Bob Iger saying, the problem is the timing of Easter, apparently. Also, that the earthquake in Japan was an issue, and Mars Needs Moms, a film I actually had not heard of, was apparently disappointing in the box office. What do you think the real problem is here?
Well, I think all of those were big factors. Disney's a difficult company to get your hands around. The company doesn't guide very specifically, and there are a lot of very particular timing issues. But I also think an issue is that they had great growth in their cable networks, driven by ESPN, but also some growth in expenses. So I think that's one thing we're going to focus on the call. Is how much is spending kind of offsetting some of the great revenue story at Disney right now.
And Barton, I'll be honest with you. Earlier today I checked out Disney's last earnings report, and that was a report. The company they rose to a record high in trading with their first quarter sales and profit topping analyst estimates. So I'm just thinking, coming off of that report to see this report is a bit of a shocker to you.
Well, it isn't a shocker. I mean, I thought that the December quarter report was tremendous. It's one of the best that Disney's ever put up. But I thought that the analyst community got a little bit overly optimistic in the wake of that. And so we recently launched coverage here on Disney. We came in at a neutral, and one of our cautions was, people had gotten too optimistic. I mean, it's a great company, but they're spending on some things, and and there's some timing issues, and I just thought people had run too hard with it.
I always like to bring this up because we're all often so short-sighted here. We do it here in terms of our coverage, even sometimes. I mean, do we want to see a company like Disney investing for future growth?
You do, and it's a company that manages for the long term, and their investments are absolutely the right thing. And this is one of these companies that you can go to sleep and feel like when your grandkids are going to college, if they had this stock, that Disney will be around and it'll be a good company. But the quarterly variations are something we've got to live with as a stock analyst. And this quarter I thought suffered from some of the timing issues, but there's really no fundamental problem, and it's a very good company, and they're doing very well across their segments if you look over a few quarters, not just one single quarter.
How do they? Well, you know what? It doesn't make sense to me that I wouldn't have heard of Mars Needs Moms. I love movies. I go to them all the time. The title sounds like something that would appeal to me. I mean, they must have dropped the ball if they didn't do well with this. What was the problem?
Well, you nailed it. I mean, it was a movie that did terribly, and it drove a meaningful write-off. And a big part of the disappointment here was in the studio segment, and I think part of that was the Mars Needs Moms write-off. It was an epic flop. It came from a division of Disney that was using some new type of animation techniques that they've really exited. They're going to go, back to better movies, I think, going forward. Pirates, Cars 2, you'll know about those, and they won't be bombs.
I got an 8-year-old. She had no interest in seeing this movie, and there are other movies she definitely wants to see. Hey, Barton, you've got a neutral rating, yet earlier you said, your grandkids, we're thinking our grandkids are going to wake up, if they own the stock today, it's going to be good when they're adults. Yet you have a neutral rating on the stock, so it seems to me like a little bit of a conflict.
Well, no. When I launched coverage, my call was it's a great company, but you don't have to buy the stock at every price and at every minute. So I wanted to wait for opportunity. So, they've had a little bit of a setback here. And, we'll take a look at it. It's a very good company. I think a little bit of a shortfall here is nothing to be overly concerned about.
Still up, as we point out, 17% year to date, up 25% over the past 52 weeks. So it has had a very good run.